Fear. It is the single most powerful, most destructive, and most universal emotion in the financial markets. It is the unseen hand that guides the decisions of millions, the primal force that fuels catastrophic crashes and prevents investors from seizing generational opportunities. It is the whisper of doubt in a winning trade and the screaming panic in a losing one. The great irony of the market is that it is an arena that demands cold, hard, rational logic. Yet it is governed by this most irrational of human emotions. Every legendary operator in history, without exception, had to confront this demon. Their success was not defined by an absence of fear, for they all felt it. It was defined by the systems, the principles, and the philosophies they constructed to manage it. This is not a theoretical discussion of market psychology. This is a practical guide to building a professional framework for managing fear, based on the hard-won wisdom of 10 of the market's greatest minds. We will begin by acknowledging a fundamental truth. Fear is not an enemy to be vanquished, but a biological reality to be understood and planned for. It is a natural, unavoidable signal from our ancient brain, a mechanism designed for physical survival that is dangerously ill-suited to the abstract world of capital. The key to long-term success is not to become fearless, but to become prepared. This analysis will deconstruct the moments when fear is most likely to strike, and then explore the first of 10 legendary strategies, the antidotes that the masters developed to neutralize this powerful emotion and avoid the wrong moves. Our primary guide on this journey will be the man whose entire career was a testament to both the power of fear and the genius required to control it, Jesse Livermore. This journey into the psychology of mastery is the core of our channel. It is a deep dive into the intellectual frameworks that separate the professional from the amateur. To continue developing these habits of disciplined analytical thought, we invite you to subscribe to this channel and click the notification bell. To construct a plan against fear, we must first perform a diagnosis. We must understand the specific moments and conditions under which this emotion is most likely to hijack our rational mind. Fear in the markets is not a monolithic entity. It manifests in several distinct and equally dangerous forms. The first and most obvious is the fear of loss. This is the raw, visceral pain that an operator feels when a position moves against them. The price ticks downward, and with each tick, the emotional pressure mounts. This fear triggers the primal fight or flight response. It clouds judgment, shortens time horizons, and often leads to one of two disastrous outcomes. Either a panicked, premature liquidation of a position based on meaningless short-term noise, or, paradoxically, a complete paralysis, an inability to accept the loss, which allows a small, manageable mistake to metastasize into a catastrophic, portfolio-destroying event. The second and more subtle form is the fear of giving back profits. This is the fear that plagues an operator in a winning trade. After a stock has produced a significant gain, the fear of a reversal, the anxiety of watching that paper profit evaporate can become overwhelming. This fear is a powerful motivator for premature profit-taking. It is the voice that whispers, "Take the money and run," compelling a trader to snatch a small, certain gain at the expense of a much larger, but less certain long-term trend. It is this fear that is the primary reason why most traders are incapable of capturing the massive multi-100% moves that create true wealth. The third form is the fear of missing out, or FOMO. This is the fear of inaction. It is the intense anxiety an operator feels while watching a market or a stock soar higher without them. This fear is driven by the social proof of the crowd and the painful feeling of being left behind. It is a powerful catalyst for undisciplined, impulsive action. It causes traders to abandon their carefully laid plans and chase stocks at the peak of a speculative mania, buying at the point of maximum risk, not maximum opportunity. The final form is the fear of being wrong. This is an ego-driven fear. It is the fear of admitting a mistake, not just to the world, but to oneself. This fear is the root cause of one of the most destructive behaviors in investing, holding on to a losing position. The trader's ego becomes so intertwined with their market thesis that they are psychologically incapable of accepting the market's verdict that their thesis is flawed. They will hold on, hoping and praying for a turnaround, not because of a rational analysis, but because selling would be an admission of personal failure. The only rational antidote to these powerful, primal, and predictable emotional responses is a comprehensive and non-negotiable plan. A professional operator, before ever committing a single dollar to a trade, has a predefined plan that covers every contingency. They have a plan for their entry, a plan for their exit in the case of a loss, a plan for their exit in the case of a profit, a plan for their position size, and a plan for how the trade fits into their overall portfolio. This plan, created during a time of calm, rational analysis, becomes their anchor in the storm of market emotion. It is the external, logical framework that they are sworn to obey, a defense against the internal, irrational impulses triggered by fear. Now, let us explore the specific strategies that the market's legends develop to build and execute these plans. Our first strategy comes from our central case study, Jesse Livermore. His entire career was a lifelong war against his own powerful emotional instincts. He was a man of supreme analytical genius, but he was also acutely aware of his own human fallibility. He knew from painful repeated experience that his greatest enemies were the twin speculators that resided in his own mind, hope and fear. Hope, he said, was the ally of the losing trade, keeping him in a bad position long after he should have exited. Fear was the enemy of the winning trade, causing him to sell a great position far too early. His first and most important strategy, therefore, was to acknowledge the power of these emotions and to engineer a set of rigid, mechanical rules specifically designed to neutralize them. Livermore's rules were his personal antidote to his own psychological weaknesses. The most famous of these was his 10% stop-loss rule. This was not a guideline, it was an absolute ironclad law. Any position that moved against him by 10% from his entry point was to be sold immediately without hesitation or debate. This rule was a surgical instrument designed for one purpose: to kill destructive hope. He knew that the moment a stock fell by 10%, his natural human instinct would be to hope for a rebound, to give it a little more time. The 10% rule was a pre-made decision that short-circuited this emotional response. It was an unemotional, mathematical admission that his initial judgment was wrong, and it forced him to preserve his capital and his mental clarity. Conversely, his rules for entering a trade and adding to a position were designed to combat fear. His insistence on buying only at a pivotal point, a breakout to a new high from a sound consolidation, was a mechanism for overcoming the fear of buying a stock that had already gone up. The breakout was an objective, market-validated signal of strength that gave him the rational confidence to act. His system of pyramiding, or adding to a position as it moved in his favor, was his strategy for fighting the fear of letting a winner run. By systematically adding to his position at predefined points of strength, he forced himself to remain in a powerful trend and to build a large, commanding line of stock. Livermore's entire method can be seen as a brilliantly engineered system of personal checks and balances, a code of conduct created by a man who knew his own mind all too well. His strategy was to admit his own psychological flaws, and then to build a rigid external framework of rules that would protect him from himself. While Livermore sought to manage his fear with a set of operational rules, our next legend, Benjamin Graham, took a different and more profound approach. His strategy was to create an entire investment philosophy so powerful, so logical, and so defensive that it made the market's short-term, fear-driven mood swings almost completely irrelevant. If Livermore's method was a tactical guide to surviving the battle, Graham's was a strategic plan for building an impregnable intellectual fortress. This philosophy was born directly from his own traumatic experiences with the fear of the 1929 crash. He sought to create a system that would allow an investor to operate with a level of calm and detachment that was simply impossible for the pure speculator. The first and most important stone in this fortress is the concept of the margin of safety. As we have discussed before, this is the principle of buying an asset for significantly less than its calculated intrinsic value. But its true power is not just mathematical, it is psychological. The margin of safety is the ultimate fear-dampening mechanism. It provides an investor with a powerful, rational anchor in a sea of emotional turmoil. An investor who buys a stock at a 50% discount to its tangible asset value does not need to fear a 10 or 20% market correction. Their confidence is not based on the stock's fleeting daily price, but on the verifiable reality of its underlying worth. This intellectual certainty provides the courage to hold a position during a panic and, more importantly, the courage to be an aggressive buyer when the market's fear is at its peak. It is the ultimate defense against the fear of loss. The second part of his fortress was the brilliant psychological tool of the Mr. Market allegory. Graham understood that the primary source of fear for most investors is their personification of the market as an all-knowing, omniscient entity. They see a falling price and interpret it as a judgment from a superior intelligence that they are wrong. Graham's allegory brilliantly inverts this relationship. He teaches the investor to see the market not as a god to be feared, but as a manic depressive and ultimately foolish business partner. This simple cognitive reframe is a psychological masterstroke. It allows the intelligent investor to detach from the market's moods. They learn to see Mr. Market's fearful, pessimistic lows not as a threat, but as a generous and foolish offer to sell them valuable assets at a bargain price. The fear of the market is transformed into an opportunity to profit from that fear. Graham's strategy in its entirety is a system for replacing emotion with reason, a method for building an intellectual fortress so strong that the fear that governs the rest of the market cannot penetrate its walls. The third strategy for planning for fear involves a deep, cynical, and practical understanding of crowd psychology. This was the domain of the great lone wolf, Bernard Baruch. His approach was built on mastering the two great fears that paralyze most investors, the fear of acting alone and the fear of the overwhelming power of a market panic. The first of these is the fear of being a contrarian. Humans are social creatures, and we have a deep-seated instinctual need for the safety and validation of the herd. In the market, this translates into a powerful fear of taking a position that is different from the prevailing consensus. It is psychologically comfortable to buy when everyone else is buying, and terrifying to buy when everyone else is selling. Baruch's entire philosophy was a conscious rebellion against this instinct. He believed, as we have discussed, that the crowd was almost always wrong at major turning points. His antidote to the fear of being a lone wolf was a deep, fact-based research process. His conviction came not from the agreement of others, but from the strength of his own independent work. This intellectual self-reliance was the source of his courage. He also had a brilliant method for managing the fear that comes at the two extremes of the market cycle. His most famous insight, the story of the shoeshine boy, was his strategy for dealing with the peak of a bull market. He recognized that the point of maximum risk is the point where there is a total absence of fear. When the public is universally euphoric, as signified by the shoeshine boy giving stock tips, the intelligent operator should be feeling the most fear. Baruch acted on this, selling his entire portfolio into the strength of the euphoric crowd. His other famous principle, selling too soon, was a direct tactic for managing the fear of a market reversal. By selling before the absolute peak, he willingly gave up the final, most dangerous part of the advance. This act of disciplined profit-taking ensured that he was never caught in the panicked, disorderly rush for the exits when the trend finally broke. It was a strategy for preemptively neutralizing the fear that he knew was inevitably coming. By understanding the psychology of the crowd so completely, he was able to act on its fear, and its lack thereof, as a powerful contrarian signal. This level of detailed patient analysis is the hallmark of a professional operator. It requires a deep and dedicated study of these nuanced principles, an understanding that the market has a hidden logic that can only be seen by those who know how to look. Recognizing this, we have created a new, dedicated resource for the serious student of the Wyckoff method. Richard Wyckoff was not just another trader on Wall Street. He was the first to systematize the hidden logic of the market. It was he who explained how supply and demand create the repeating cycles of accumulation and distribution that are still in effect today. To explore these principles more deeply and to go step by step through the market phases and rules of Wyckoff, we have created a separate channel, Richard Wyckoff Trading Methods. We invite you to subscribe. A link is in the description. Having established the foundational frameworks for managing fear, the self-aware rule-based system of Jesse Livermore, the intellectual fortress of Benjamin Graham, and the contrarian wisdom of Bernard Baruch, we now move to a more advanced level of mastery. The first three strategies were primarily defensive in nature, designed to protect the operator from the destructive power of their own emotions and the irrationality of the crowd. The next set of strategies explores two divergent but equally powerful paths. The radical attempt to engineer human emotion out of the process entirely, and the profound art of transforming fear from a debilitating liability into a powerful, actionable signal for both defense and offense. These are the methods that separate the merely disciplined from the truly elite. Our fourth strategy comes from one of the great pioneers of systematic trading, Ed Seykota. His approach to the problem of fear was that of a true engineer. He did not see fear as a psychological demon to be wrestled with or a market sentiment to be interpreted. He saw it as a fundamental bug in the human operating system, a flaw in the machine that consistently produced catastrophic, irrational decisions. His logical conclusion was that if the human component was the primary source of error, then the most effective solution was to remove it from the decision-making loop as much as possible. His entire career was a quest to build a mechanical trading system that could execute a proven edge without any emotional interference. The core of the Seykota solution is the belief that a complete mechanical trading system is the ultimate antidote to fear. This is because such a system pre-makes every single decision in a state of cold, rational, and statistically validated logic. The fear of loss, the fear of missing out, the fear of giving back profits, all of these emotional pressures are rendered irrelevant if the operator's only job is to flawlessly execute the system's signals. The entry signal, for example, is unambiguous. It is a mathematical event, such as a short-term moving average crossing above a long-term one. There is no room for the fear-based hesitation of, is this the right time to buy? The system gives the signal and the operator acts. The most powerful fear-killing component of his system is the predefined stop-loss. Before a trade is even entered, the system knows the exact price at which the thesis is wrong, and the position must be liquidated. This eliminates the hopeful paralysis that is the primary cause of ruin. The trader is not forced to make a difficult emotional decision in the heat of a losing trade. The decision has already been made by the algorithm. The exit of a profitable trade is equally systematic. The system has a specific rule for when a trend is considered to be over. This is the antidote to the fear of giving back profits. The trader does not sell because they are scared of a pullback. They sell only when the system gives a clear, objective signal to do so. This transfers the entire burden of decision-making from the fallible, emotional human to the rational, unemotional machine. However, Seykota was also the first to admit that this solution created a new, and in some ways more difficult psychological problem: the immense challenge of following the system. Trend-following systems, like the ones he designed, are notoriously difficult to trade from a psychological standpoint. They are characterized by a low win rate, often being profitable on only 30 to 40% of their trades, and they are subject to long, deep, and painful drawdowns when the markets are in a non-trending, choppy state. It is during these prolonged periods of negative feedback that a trader's faith in the system is tested to its absolute limit. This is where fear reemerges, not as a fear of a single trade, but as a fear that the entire system is broken. This is why Seykota's later work shifted from focusing on the system to focusing on the trader. His most famous and controversial quote, "Everybody gets what they want out of the market," is his ultimate statement on the psychology of fear and failure. He came to believe that if a trader was consistently failing to follow their system, it was because, on a subconscious level, they were not truly seeking profits. They were seeking something else: the emotional drama of gambling, the thrill of risk, or even the psychological validation of failure that confirmed a negative self-image. The fear of success, he argued, can be just as powerful as the fear of loss. Seykota's ultimate solution to fear, therefore, was a two-part process. First, build a robust mechanical system to remove the need for discretionary emotional decisions. And second, engage in the deep, difficult, and honest work of aligning one's own subconscious intentions with the conscious goal of methodical, disciplined, and often boring profitability. While Seykota sought to engineer fear out of the trading process, our next legend, George Soros, took a radically different and more introspective approach. Instead of ignoring or eliminating fear, he learned to listen to it. His strategy was to use his own feelings of fear and anxiety, not as a source of panic, but as a sophisticated, intuitive diagnostic tool. This method is a direct extension of his core philosophy of fallibility. As we have discussed in a previous analysis, Soros operates from the foundational belief that his own understanding of the world, and therefore his thesis for any given trade, is inherently flawed and incomplete. His starting assumption is always, "I am likely wrong." This creates a healthy, productive state of intellectual paranoia, a constant hunt for the error in his own reasoning. His most famous application of this principle is his use of his own physical sensations as a risk management signal. He has spoken often of how, during the most intense periods of running his quantum fund, the state of his portfolio would manifest as a physical feeling. He famously used the onset of acute back pain as an alarm bell. This was not a mystical or supernatural event. It was a form of highly developed subconscious pattern recognition, a skill honed over decades of all-consuming focus on the markets. The physical pain was his subconscious mind screaming that something was fundamentally wrong with his portfolio, that there was a flaw in his conscious thesis that he had not yet identified, or that his position size had grown beyond his true level of conviction. It was a biological early warning system, a physical manifestation of his portfolio's hidden stress. The crucial difference is in his reaction to this fear signal. The amateur trader, when they feel a surge of fear, is prone to a single impulsive action. They sell. They liquidate the position to make the pain go away. Soros's reaction was the opposite. The feeling of fear was not a signal to act, but a signal to think. When the back pain started, he would not immediately liquidate his positions. Instead, he would take it as a clear sign that he needed to stop, to step back, and to reevaluate his entire portfolio with a fresh and intensely critical eye. He would often cut his position sizes across the board, not to exit the trades, but to reduce his overall risk to a level where he could once again think with perfect clarity, free from the paralyzing grip of intense anxiety. He used his fear as a catalyst for more rigorous analysis. He listened to the signal his body was giving him and used it to find the hidden flaw in his thinking before the market could find it for him. This is an advanced introspective strategy, a masterclass in turning a psychological liability into a powerful analytical edge. While Graham's strategy was to build a defense against fear, his greatest student, Warren Buffett, learned to transform that defense into a powerful offensive weapon. Buffett's approach to fear is perhaps the most quoted and most misunderstood in all of investing. His famous doctrine, "Be fearful when others are greedy, and greedy when others are fearful," is the ultimate contrarian instruction on how to systematically exploit the emotional cycles of the market. It is a strategy for turning the market's collective fear into a generational buying opportunity. Let's deconstruct the two sides of this maxim. The first part, "Be fearful when others are greedy," is a powerful defensive principle. It is Buffett's rule for avoiding speculative bubbles. He understands that the point of maximum financial risk is the point of minimum perceived risk. When the public is euphoric, when the narratives are of a new paradigm, and when the fear of missing out has completely supplanted the fear of loss, the intelligent investor should be at their most cautious. This is the time to be fearful, not of missing out on further gains, but of the inevitable collapse that follows such periods of speculative excess. This discipline is what allowed him to sidestep the worst of the dot-com crash, publicly warning that the valuations of technology stocks had become detached from business reality. The second part of the maxim, be greedy when others are fearful, is the offensive core of his strategy. For Buffett, a market crash, a period of widespread panic and maximum public fear, is not a disaster. It is a rare and wonderful opportunity. It is the moment when Mr. Market, in a fit of despair, offers to sell truly wonderful businesses at absurdly low prices. The intelligent investor's job is not to share in this panic, but to exploit it with aggressive buying. But how is Buffett able to remain greedy and rational when the entire world is consumed by terror? The answer lies in the foundation of his entire philosophy, the circle of competence. Buffett's courage is not a personality trait. It is a direct result of his knowledge. He has a simple rule. He only invests in businesses that he can thoroughly understand. By staying strictly within this circle, he is able to analyze a company during a panic and to know with a very high degree of certainty its long-term intrinsic value. While other investors are panicking about the daily downward fluctuations of a stock's price, Buffett is calmly focused on the long-term durable earning power of the underlying business. This deep factual knowledge is the ultimate antidote to the market's infectious fear. It gives him the profound, unshakable conviction to act. A prime example was his investment in American Express during the Salad Oil scandal in 1963, and more recently, his multi-billion-dollar investments in Goldman Sachs and Bank of America at the absolute height of the 2008 financial crisis, a time when many believed the entire global banking system was on the verge of collapse. His ability to act greedily during these moments of extreme fear is a direct result of the intellectual work he has done to build a fortress of competence. Our final strategy in this section comes from the world of short-term professional trading, where the operator is exposed to the fear of loss not on a cyclical basis, but on a daily and sometimes even hourly basis. This is the world of Linda Raschke. For a short-term trader, the fear of the outcome of the very next trade can be a paralyzing force, leading to hesitation, missed entries, and the premature exit of winning trades. To combat this, Raschke developed a powerful psychological framework that reframes the entire endeavor of trading. Her antidote to the fear of outcomes is an obsessive focus on a flawless process. She famously describes her approach as trading as a performance art. This is a profound and powerful metaphor that completely changes the trader's objective. Like a concert musician or a professional athlete, she views the act of trading as a performance. The outcome of any single performance or trade is not entirely within her control. There is always an element of luck and randomness in the markets, just as a gust of wind can affect a golfer's shot. What is entirely within her control, however, is the quality of her preparation and the flawlessness of her execution. Her primary goal, therefore, is not to have a winning trade, but to have a perfectly executed trade, and regardless of its outcome. This shift in focus from outcome to process is a psychological masterstroke. It detaches the trader's ego and self-worth from the random, unpredictable result of any single event. Her daily routine mirrors that of a professional performer. It involves a rigorous pre-market preparation, where she studies the charts, identifies her high-probability setups, and formulates a clear plan of action. During the trading day, her job is execution. She acts as a disciplined technician, following her pre-made plan with the focused, unemotional precision of a surgeon. After the market closes, she conducts a post-game review, analyzing her performance, not just her profit and loss statement. Did she follow her rules? Did she execute her plan without hesitation? did she manage her risk according to her system? By making a perfect process the goal, she neutralizes the fear associated with financial outcomes. The long-term profits, she knows, are simply the inevitable byproduct of a relentless day-in, day-out commitment to a perfect process. Having explored the foundational defenses against fear and the systematic offensive strategies for exploiting it, we now ascend to the highest level of operational mastery. The final set of principles is not about simply reacting to fear or building walls against it. It is about creating advanced mental frameworks, complete operating systems for the mind, that are so robust they structurally re-engineer the speculator's relationship with fear itself. The legends who employ these frameworks do not just manage fear. They design their entire process around its mathematical and psychological realities. They move from being participants in the emotional drama of the market to being objective architects of their own decision-making. These are the advanced strategies that separate the merely great from the truly transcendent. Our eighth strategy comes from a modern master of risk and speculation, Tudor Jones. His approach to fear is one of profound mathematical elegance. He does not seek to conquer fear through sheer willpower. He seeks to make it mathematically insignificant. The entire foundation of his defensive doctrine, the 5-to-1 rule, is a powerful fear management tool. The principle states that he will not enter a trade unless he sees a realistic potential to make $5 for every $1 he is risking. On the surface, this is a rule of trade selection. But on a deeper psychological level, it is a system for defining fear almost out of existence. Let us deconstruct the psychology of this asymmetry. The primary source of a trader's fear is the potential for a large, debilitating loss. The fear of being wrong is amplified by the fear of the consequences of being wrong. Jones's method attacks this problem at its root. By insisting on a 1R, or a small, strictly defined unit of risk on every trade, he systematically minimizes the emotional impact of any single loss. A small, pre-planned loss does not trigger the same primal fear response as a large, unexpected one. It is a calculated business expense, not a personal catastrophe. This makes the act of being wrong, which is an inevitable part of trading, a psychologically manageable event. The sting of the loss is removed. Simultaneously, the 5R potential on the other side of the equation creates a powerful positive expectancy that psychologically overrides the residual fear of the small loss. When a trader knows that a single winning trade can erase 5 or even more losing trades, their entire mental framework shifts. The process is no longer about avoiding the pain of the next loss, but about patiently seeking out the next great opportunity. It transforms trading from a game of avoiding mistakes into a game of finding breakthroughs. The fear of loss is replaced by the confident patience of a professional who knows the long-term mathematics are overwhelmingly in their favor. Furthermore, the 5-to-1 rule acts as a powerful filter for emotional conviction. If an operator cannot find a setup that meets these strict asymmetric criteria, it is often a sign that they do not truly have a strong analytical edge. The fear or hesitation they might feel is a rational signal that the trade is not good enough. The rule forces them to pass on these mediocre 50-50 opportunities and to wait for the rare moments of profound market dislocation where a true asymmetric bet exists. It is a discipline that channels capital only towards the highest conviction ideas, which are, by their nature, the easiest to hold with courage. In essence, the Jones doctrine does not eliminate the possibility of loss, but it fundamentally redefines the trader's relationship with it. It turns fear from a paralyzing, amorphous emotion into a simple, quantifiable input in a rational risk/reward calculation. Our ninth strategy addresses a different but equally powerful source of fear, the fear of the unknown. A primary cause of anxiety and irrational decision-making in the markets is the feeling of operating in an environment that is too complex, too unpredictable, and too far outside of one's own understanding. This fear of uncertainty causes investors to either become paralyzed, unable to act, or to follow the herd, outsourcing their thinking to the perceived safety of the consensus. The intellectual architect of Berkshire Hathaway, Charlie Munger, developed a powerful antidote to this specific fear. His strategy is the relentless and disciplined application of the circle of competence. The principle is simple in its statement. An investor must define the perimeter of their own specialized knowledge and never, under any circumstances, stray outside of it. The power of this idea, however, is not in its simplicity, but in the profound intellectual humility it requires. For Munger, the goal is not to have a massive circle of competence. The goal is to have a brutally honest and accurate understanding of where the circle's edge lies. The single most important skill for a long-term investor is the ability to say, with confidence and without ego, "I don't know." This principle is a powerful fear management tool because it transforms the vast, terrifying universe of potential investments into a small, manageable, and deeply understood territory. By refusing to operate outside their circle of competence, the investor eliminates the anxiety and fear associated with making decisions in areas where they are at a fundamental informational disadvantage. Their confidence is not based on a broad, superficial knowledge of many things, but on a deep, almost absolute mastery of a few things. When a market panic occurs, an investor who owns a portfolio of businesses they do not truly understand will be consumed by fear. They have no anchor, no way to gauge if the falling prices are a temporary fluctuation or a sign of permanent business deterioration. They are at the mercy of Mr. Market's moods. But the investor who, like Munger, owns a handful of businesses that they understand as well as their own family, can face a market crash with equanimity. While others are panicking about the stock prices, the Munger-style investor is calmly reevaluating the long-term durable earning power of their businesses. This deep factual knowledge is the ultimate source of their conviction, and it is the ultimate antidote to the market's infectious fear. The most famous practical application of this principle was Munger and Buffett's decision to completely avoid the technology bubble of the late 1990s. While the rest of the world was gripped by a euphoric mania for internet stocks, they were publicly criticized for being out of touch and missing the new paradigm. Their refusal to participate was not a bearish market call or a prediction of the crash. It was a simple and honest admission that the long-term competitive dynamics, the business models, and the valuations of these technology companies were far outside their circle of competence. They did not understand them, and therefore they did not play. While others were experiencing the twin fears of missing out on the way up and losing everything on the way down, Munger and Buffett felt no fear because they were not playing a game they did not understand. The circle of competence is a strategy of omission, a powerful filter that protects the investor from the most dangerous threat of all, their own ignorance. Our final strategy for mastering fear comes from another modern philosopher of the market, Howard Marks. His approach is designed to combat the most disorienting aspect of market fear, the feeling that this time is different, that the current crisis is unique, unprecedented, and therefore terrifyingly unpredictable. Marx's solution is to provide context. His entire intellectual framework is a tool for contextualizing fear, for understanding that the emotional extremes we experience in the market are not random events, but are a normal, predictable, and endlessly repeating part of a larger cycle. His most powerful tool for this is his metaphor of the market pendulum. He teaches that market psychology is like a giant pendulum, constantly swinging between two extremes. Euphoria on one side, where greed is the dominant emotion and risk is perceived as non-existent, and depression on the other, where fear is the dominant emotion, and risk is perceived as infinite. The crucial insight is that the pendulum spends very little of its time at the happy medium, the rational and objective center. Its natural tendency is to swing toward and through the extremes. By internalizing this model, the superior investor can learn to see a moment of intense, widespread fear not as the end of the world, but as a normal, albeit extreme and entirely predictable swing of the psychological pendulum. This framework allows the investor to shift their perspective from that of an emotional participant to that of a clinical observer. The question changes from, should I be scared, to, okay, the pendulum is now at the extreme of fear. What does our process dictate we do in this environment? It transforms fear from a terrifying personal experience into an objective data point, a valuable indicator of where we are in the cycle. Marx teaches that the investor's job is not to predict the exact timing of the swing, but simply to know where we stand. By assessing the current state of the economic cycle, the credit cycle, and most importantly, the sentiment cycle, the investor can build an objective map of the current emotional environment. This map is the ultimate antidote to the disorientation that fear creates. It allows the operator to act with a sense of historical perspective, to be a buyer when the pendulum is at the extreme of fear, and a seller when it is at the extreme of greed, with the quiet confidence of someone who has seen this movie before and knows how it ends. In conclusion, the journey through the minds of these 10 legends reveals a profound and empowering truth about the nature of fear in the financial markets. The ultimate mastery of this powerful emotion is not a single act, but a multi-layered, lifelong process. It begins with the self-awareness to acknowledge fear's power and the discipline to build rules-based defenses against its most destructive impulses, as taught by Jesse Livermore. It evolves into the construction of a complete intellectual fortress, a philosophy like Benjamin Graham's that is so robust it can render market panic irrelevant. It requires the contrarian courage of a Bernard Baruch to read and act against the fear of the crowd. It can lead to the radical solution of an Ed Seykota, who sought to engineer fear out of the process entirely, or to the introspective method of a George Soros, who learned to listen to his own fear as a valuable signal. At its highest levels, it transforms into an offensive weapon, the Buffett doctrine of using the market's fear as a generational buying opportunity. It is refined by the process-oriented discipline of a Linda Raschke, who focuses on flawless execution to neutralize the fear of outcomes. And finally, it is encased in the advanced mental frameworks of the modern masters. The mathematical elegance of a Tudor Jones, who defines fear away with asymmetry. The profound humility of a Charlie Munger, who avoids fear by knowing his own limits. And the philosophical perspective of a Howard Marks, who contextualizes fear within the timeless cycles of the market. Before we conclude, we want to extend our gratitude to you, our viewers. We put an immense amount of research and effort into creating these deep dives, and your engagement is what makes it all possible. To everyone who watches, who subscribes, and who takes the time to leave a thoughtful comment, thank you. Your participation is what helps these videos reach a wider audience on YouTube. A special thanks is due to those of you who have supported the channel through the Super Thanks feature. Your direct support is a powerful motivator for us to continue this work and to keep raising the bar on the quality of our analysis. As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.